Hello.
हेलो।
Yeah, hi Varunika.
हेलो सुधा जी, कैसे हैं आप?
मैं बिल्कुल ठीक हूँ।
तो सुधा जी स्टार्ट करो आप, आई थिंक इनॉग्रल स्पीच से।
हाँ, I think Tista has joined. So we'll start.
Yeah, you should start.
So I would like to welcome everyone to this webinar today, organized by our AVP. And I can see that members are still joining. So I think we'll wait for another 1 minute.
Okay, in 2-3 minutes you can start.
Yogesh ji, namaste, sir. Sir, you are on mute.
Namaste, madam. Namaste.
Okay. How are you, sir?
I am fine. Thank you. How are you, madam?
Good, sir. Good. Thank you, sir. Thank you. Thank you so much for taking out time and addressing all of us
No,
and sharing your knowledge.
no. I will also gain in the process, madam.
Yes, sir. Thank you, sir. So friends, welcome to our webinar on fixed securities today, which shall be taken up by our learned speaker, Shri Yogesh Chatwani ji. And so I'm very happy that all of you have joined. You know, webinars, seminars, knowledge sharing is continuous part of our evolvement and our knowledge enhancing as a registered valuer. Things keeps on changing and there is so much to learn that no matter how much we already know, there is equal and more amount of knowledge that we can acquire. And every bit of knowledge that we acquire helps us not only in executing our work well, but in totality, it's always helps our clients as well. So there are two things that I'll speak for 2 minutes. One is the evolvement of ESG. That is the new subject area that is coming up nowadays all over the globe. The climate change has been of the concern and sustainable development have taken center stage in the global and national priorities. There is a growing recognition of significant financial and economic impacts of environmental, social, and governance risks across the globe, with many international bodies and financial regulators examining ESG-related issues, including regulations and supervision. So there had been a recent survey by IVSC to explore the degree at which ESG, that is environmental, social, and governance components, are being considered in the valuation process. So my humble request to all the RVs and valuers who have joined today and those who are listening to us after this webinar, to start taking into consideration the ESG part into their valuation. ESG is a part of journey for the valuers in relation to quantification in their valuation workings, the components of environmental, social, and governance, which effectively and collectively add to the performance with positive benefits for the wider market, society, and world as a whole. The second thing which is relevant is presentation of our reports. Please make sure that you are giving your reports as per the IVSC standard 103 read with IBBI guidelines on caveats, limitation, and disclaimers. So this is I thought I'll share my views on this today. And apart from that, the topic for the today is very, very interesting. That is fixed income securities, valuation of fixed income securities, which I'm sure only a person like Yogesh Chatwani ji could have handled. And to apprise you all, he is the person who passed his IP exam with 89% and RV exam with 72%. He is a CMA otherwise, and he is retired from Indian Oil, Ahmedabad. So, sir, this is the most difficult subject I know. I mean, valuation of fixed income securities is one of the most difficult and subject, and we appreciate and we are really thankful to you that you have chosen this subject for webinar today. I would request now Atista to take it ahead for the formal introduction of Yogesh ji. Thank you, everyone.
Thank you.
Hello, everyone. I'm Varunika. So I take it from here from Sudhaji. Let me share my screen first. Now you can see my screen?
Yes, yes, okay.
So good evening, everyone. On behalf of the Association of Valuation Professionals, I, Varunika Gupta, hereby welcome you all to today's webinar on the topic of valuation of fixed income securities. The sole objective of AVP is to work in national interest in professionalizing valuation as a vocation. AVP has tie-ups with two organizations, as you can see on the screen, IIV-RVS and SME. So any professional interested in valuation can become a life member of AVP by paying a membership fee of 5,000 only. So this is one-time payment only. And now I would like to present you the milestone achieved by AVP within 8 months of its operation. AVP has a tie-up for CEPR with IIV-RVF, RVO Pune. We already have a strong strength of 155 members, which includes members from foreign countries, iconic personalities, and prominent speakers. We have already published 9 newsletters and conducted 45 webinars covering different topics and held by legends. Now it's time to know a little about our tie-ups, IIV-RVF. IIV, the Indian Registered Valuer Foundation, is recognized by IBBI as a Registered Valuer Organization, RVO. Mr. Ilyas Amin Sheikh is the Managing Director of IIV-RVS. Till date, IIV-RVS has trained 1,400 members of IBBI, 50 hours training, and more than 246 members have successfully registered with IBBI. A little about SME Chambers of India. SME Chambers is working for the development of SMEs from manufacturing, service sector, and allied industrial and business sectors for last 28 years. It is providing unique support to SMEs, young and women entrepreneurs, and startups. They also provide support in channelizing finance from banks and FIs. So now the main question, why join AVP? So here are the few benefits that AVP offers to all its members. So all the webinars that AVP conducts are free of cost, and it conducts at least 2 webinars in each month. It provides mentoring new registered valuers and to students who want to appear for valuation exams. It provides monthly e-newsletters for knowledge sharing. AVP has formed various study groups to enrich our knowledge in particular area of work. It has also conducted 26 days knowledge sharing events for the upcoming webinars that you will see in the following slides. CEPRs will be granted by IIV RVO that we have seen. So this is our journey so far of all the webinars that has been conducted from the 11th February 2021 on the topic of ease of valuation. And yes, here it is. Now we are here on 25th March for the valuation of fixed income securities. So many webinars had already been conducted by AVP. And upcoming webinars are also listed here. So from 8th April, that is Friday, we have our webinar on startup pitch and valuation of overseas investors. So you can see it here that from April till October, we have a list of webinars, upcoming webinars that will be conducted by AVP. Planning has already been made. So, for any query, please contact our president, Mr. Ram Mohan sir. And for membership assistance, you may contact Mr. Nitin Dhamma. And for webinar related queries, please contact Sandeep Agarwal also. Now I would like to request Mr. Sandeep Agarwal sir for the introduction of our esteemed speaker for today's webinar. Thank you.
Yes, you can close the screen. So our senior member Nataraja, who is also treasurer of our society, will introduce the speaker of the day, Yogesh ji. So Nataraja ji, please introduce.
Thank you, Sandeep ji. I'll do the introduction of Yogesh ji. It's a privilege to really introduce our senior most member and friend Yogesh Chatwani sir. He is a MCom FCMA from Ahmedabad. He has a very rich experience of 38 plus years in the field of finance and indirect taxation. He actually retired from Indian Oil Corporation as Chief Manager Finance in June 2021 and has 35 years of experience in IOC. He has rich and varied experience in the entire gamut of indirect taxation, namely GST, customs, DGFT, GVAT, CST, excise, service tax. He has started as a practicing cost accountant from July 21. He's also a registered insolvency professional, faculty with RVOs, passionate about teaching and sharing knowledge. He has completed RV, SFA, and IP as well. And he's a CPA from USA, completed in 2008. Sir, we are really happy to have you, your rich experience and what should I say, always learning attitude and teaching attitude. Thank you so much, sir. We are privileged to have you. Over to you for the session.
Thank you, Natarajan ji, for your kind words, sir. At the outset, I express my sincere thanks to the entire team of AVP under the leadership of veteran Ram Mohan Bhave ji for giving me this opportunity. I also thank Sandeep ji, chairman of organizing committee of today's webinar, Natarajan ji, Sudha madam, Varunika ji madam, Tista Gupta madam, who made untiring efforts in organizing today's webinar. I also thank each one of you for sparing your valuable time to attend this session. Our today's topic is related to valuation of fixed income securities. Now a question will arise, why this topic? Because normally we do not have discussions on this topic. Our topic of discussion is always equity markets or mutual fund markets or financial derivatives markets or commodity markets or bullion markets or real estate markets or superannuation schemes or insurance sector and this list will go on actually. Hardly we speak about fixed income security markets. Now in reality, debt market is perhaps the biggest of all markets. And another reality is a fixed income security market is the king of not only debt market, but perhaps all other markets. That is how I have selected this topic of fixed income securities today. Now in finance, we are familiar with the concept of no risk, no gain. But majority of us are risk loving. Majority of us are risk averse. We are not risk loving. We professionals mostly come from middle class and we are peace loving people. There may be different classes within the umbrella of middle class, upper middle class or lower middle class and so on. But majority of us are from middle class. We always look forward to risk-free returns. But problem is historically debt market, particularly secondary debt market is not accessible to retail investor as it should be. In the recent past only RBI has facilitated access of secondary GSEC markets to retail investors. Through today's session, I have made an attempt to share with you whatever little knowledge on the subject I have. Now I will share my PPT with you. I hope it is visible. Yes, sir. Now, coverage of this session will be introduction to debt markets, retail direct scheme notified by RBI, fixed income securities, including government securities, money market securities, valuation of fixed income securities, credit rating agencies, international valuation standard related to financial instruments, Institute of Chartered Accountant of India's valuation standards related to financial instruments, FIMDA guidelines on valuation of investment, and Indian accounting standard that deal with financial instruments. Now, this is actually structure of capital markets. We have mainly two markets, equity market and debt market. Again, under equity market, we have primary market and secondary market. And same is the case with debt market, that is primary and secondary market. But we do not access debt secondary market on a regular basis as we do in case of equity market. So secondary market actually subsequent trading of debt instrument is carried out. And in the recent past, actually, this market is open for retail investors also, this secondary debt market. So we will see during the this presentation what exactly is the process of opening account with RBI. Now, debt or bond market sectors, we all know debt market, internal market, or national market, and we also have external or foreign market like US bond market, and within internal or national market we have again domestic and foreign markets. Now, Indian debt markets is the pillar of the economy. The debt market plays a very crucial role for any growing economy, like India is a growing economy. A growing economy needs to employ a large amount of capital and resources for achieving the desired industrial and financial growth. The Indian economy, which has grown at more than 7% per annum in last decade may achieve double-digit growth also in future. Now, robust and active debt market in India is the need of the hour, because as we all know, in last budget also government has lined up huge expenditure on capex. So robust and active debt market is the need of the hour. Government security market called GSEC market is the oldest and the largest component of the Indian debt market in terms of market capitalization, outstanding securities and trading volumes. GSEC market plays a vital role in Indian economy as it provides the benchmark for determining the level of interest rates in the country through the yields on government securities, which are referred to as risk-free rate of return in any economy. And we as valuers are well versed with these terms, risk-free rate of return, because it is the foundation of computing cost of capital. Now, actually, this is means internal debt of government of India. This is actual for the financial year 2021. So as we can see, our total internal debt is to the tune of 80,38,972 crores. This is only of central government. If we add up state government, public sector units and other corporates, then this figure will go up. Out of this, actually, a whopping 68% is of treasury bills. Treasury bills are short-term bills, as we all are aware, of 14 days tenure, 91 days tenure, 182 days tenure, 364 days tenure. So 54,36,125 or 68% is due as at 31st March 2021. Security against small saving 7%, market loan 15%, and others, which includes this ways and means advance, switching of security, case management bills, special security, public sector bank, etc. It is consisting 10%. Now, when I was adding up this figure from the financial statement of government of India, I found there was a totaling error. Actually, there is a totaling error in the financial statement which are presented before Parliament in last budget, actually. And that totaling error is to the tune of 1,14,000 crores, actually. So I was surprised and I added up 2-3 times, but still since it was a shortcoming, or since it was an error, it remained. Now we can see, actually, if a company makes such mistake, or auditor certifies such financial statement during audit, then how much criticism company or auditor may get. But here this is a public document, and this shortcoming has come. I have actually noticed this shortcoming from the financial statements of none other than central government. Now, debt markets in India, we have government securities markets, PSU bond markets, corporate security markets, and within government security markets, as we all know, it is the oldest and most dominant market, that is GSEC market, principal segment of debt market, and plays a role in setting benchmarks in the financial markets as a whole. Under PSU bond markets, as we all know, developed since the late 80s, and corporate security markets evolved and is growing fast after liberalization, which commenced from the year 1993. Now, debt market segments and issuers under government securities, we have central government and state government, public sector bonds, again, government agencies, statutory bodies, and public sector units. Private sector bonds are issued by corporates or bank or financial institutions. Now, debt securities of GSEC, again, central government and state government, and central government zero coupon bonds, treasury bills, and dated security. These three are major components. Now, zero components are nothing but it is arrived from stripping of dated securities. As we all know, there is a process of stripping through which actually coupon and principal elements of a dated securities are separated and traded separately. That is how it is called zero coupon bond. So zero coupon bond, treasury bills, as we all have seen, it is comprising of 68%, nearly 68%. So it is a major components, and RBI is the bankers for central government and state government. So RBI on a regular basis auction this GSEC on behalf of central and state governments. And under central government, we have another component called strips, which I just explained. It is a separate trading of registered interest and principal security. Then state government, mostly they issue coupon bearing bonds. Now, debt instrument, public sector, we have public sector bonds, and under public sector bonds, there are two categories: government agencies and statutory bodies and public sector units. Now, under government agencies and statutory bodies, again, subcategories are government guaranteed bonds, debentures, and under public sector units, again, debentures, PSU bonds, and commercial paper. Private sector bonds mainly issued by corporates, and which comprises of bonds, debentures, commercial papers, floating rate bonds, zero coupon bonds, and inter-corporate deposits. Now, private sector bonds, again, we have two categories: banks and financial institutions. So banks, again, certificate of deposits, debentures, and bonds, and financial institution also certificate of deposits and bonds. Now, wholesale debt market segment. Government security market, the largest and oldest components of security market, a very active segment on BSE, Bombay Stock Exchange, since the beginning of the 19th century. Government papers are traded actively at stock exchanges. Wholesale debt market segment of government securities for institutional investor was introduced by Bombay Stock Exchange pursuant to issuance of guidelines by RBI in the year 2000. And the guideline facilitated banks, primary dealers, and financial institutions in India to undertake transaction in debt instrument among themselves or with non-bank clients through the members of Bombay Stock Exchange Limited. Now, retail trading in government securities. Government of India and RBI recognize the need for retail participation in GSEC markets. As we all are aware, we Indians actually we do lot of savings. So this was and our saving goes either in means bank deposits or equity markets or mutual fund markets or real estate or bullion markets, gold, silver, etc. But debt and particularly debt market and particularly GSEC market is a very good opportunity for retail investors also. So looking into this, actually Government of India and RBI announced a scheme to enable retail participation through non-competitive bidding facility in GSEC auction way back in the year 2000. But between 2000 and 2021, it was through intermediaries, not direct access. Reservation of 5% of the issue amount for non-competitive bids by retail investors, and the Indian fixed income markets, which was the mainstay of the wholesale investors, were thus made accessible to the retail investors. India nurtures a culture of savings. Need was felt for long for active participation of the large number of Indian investors in fixed income debt market. Now this is actually new scheme, RBI retail direct scheme. So retail direct scheme is a one-stop solution to facilitate investment in government security by individual investors, which is made effective in the recent past, to be precise from 12th of July 2021. Now, individual retail investors can open gilt security account, that is known as a retail direct gilt account with RBI. The procedure for opening of RDG is simple and swift actually. I have personal experience also, and I found it is very simple and swift. The holders of RDG account can place non-competitive bids in primary issuance of all central government securities, which includes Treasury Bills, sovereign gold bonds, dated securities, etc., as well as securities issued by the state governments. The holder of this retail direct gilt account can also access secondary market of central government and state government securities through this portal, which is known as NDS OM portal, which is nothing but RBI's trading system. One good thing about this account is no fee or charges for opening and maintaining this account actually. If we maintain our demat account with other depositories, then they charge fees for maintenance of account and for securities as well, for purchase and sale of securities. But here there are no charges, and it is a good facility for retail investors. The holders of RDG account can also avail the other facilities like nomination, gifting, pledge, lien, transfer, etc. This Clearing Corporation of India Limited, or CCIL, is authorized by the RBI to act as an aggregator of for primary issuance and receiving office of sovereign gold bonds for the retail direct investors. Now, what is the role of CCIL? Just I have opened this RDG account, like that there may be lakhs or crores of Indians who may have opened this retail direct gilt account with RBI. So whatever we actually order or we place order during auction of government security, those orders are aggregated by the CCIL, and one order is placed with the RBI. So that is the main role of CCIL. CCIL is also authorized to operate NDS OM platform. Now this is the actually means website of RBI invest in, so means RBI retail direct account, and this process is very simple actually. At least I found it is very simple, and the website is also given here, rbidirect.org.in. Now, this is actually secondary market. So under secondary market is a screen-based electronic order matching system for secondary market trading in government securities owned by RBI. So once you open your this primary RDG account, you will also get credential for this DSOM portal, provided you make a request actually. The membership of the system is open to entities like banks, primary dealers, insurance companies, mutual funds, entities who maintain the subsidiary general ledger accounts with the RBI. Now, incidentally, this SGL is related to Harshad Mehta scam, very old Harshad Mehta scam. Access to NDS OM by the retail segment comprising of individual investors having retail direct yield account or RDG account, desires of participating in GSEC market is facilitated by allowing them to use their RDG accounts for their transactions and holding GSEC. Just like in other DMAT account, we are holding securities, we can hold through this account also. This access would be facilitated directly without the investor having to come through a bank or intermediary. This is a good thing about this account, because prior to 2021, we have to come through either a bank or intermediary. The scheme facilitates efficient access to retail individual investor to the same GSEC market being used by large institutional investor in a seamless manner. Now, this is actually secondary market screenshot I have taken. Usually we trade in mutual funds or equity markets, but to this extent, actually, we we may not actually trade in a secondary debt market. So this is a screenshot here. Actually, we are required to give our bid amount. Then it will be matched by the portal with ask amount. And if it comes through, then securities means the deal will be done actually. This is odd lot market watch actually. So we as a retail investor will mainly trade in this odd lot market sector. And apart from this, T-bill market is also a very big market, because it is a short-term duration. The tenure is very less actually of T-bills, limited maximum to 364 days and starting with 14 days. So this is actually recent auction of government securities. It is just a couple of days back, Treasury Bills dated 23rd March 2022. And here we can see the yield to maturity or YTM. For 91 days, it is around 3.8%. And for 182 days, it is around 4.32%. And for 364 days, actually, it is 4.62%. And one good thing about it is for non-competitive bids which are accepted is to the tune of 100%. So retail investors actually get a preference over these institutional investors. A retail investor can make a bid, one bid only, and which may go up to 2 crores actually. So maximum limit for one bid by a retail investor is to the tune of 2 crore rupees. And this is actually recent auctions of state government securities. As we can see, Haryana 2029, Maharashtra 2026, and Rajasthan 2032. And the weighted average yield or cutoff yield means retail investor get allotment based on this weightage average yield, and cutoff yield is at which because there will be various institutionals or various players, and they will give different quotes. So RBI decides this cutoff yield, which for Haryana 2029 it is 7.09, and these cutoff bills are different for different institutions or for different buyers of government securities. So they arrive at a weighted average yield, and that weighted average yield is offered to retail investors because as we all know, this retail investor bid is non-competitive bid. So non-competitive bid means he has nothing to quote actually. Allotment will be done based on this weightage average yield. So as we can see, it is around 7% and 6% for a tenure ranging from 3 years to as high as 10 years actually. So what is the future of our interest payment? We can have a clear picture from these actually. Now moving to fixed income securities, one of the we all know one of the most innovative and dynamic instruments evolved in the financial system ever since the inception of money, based on the concept of interest and time value of money, fueled the explosive growth of the financial markets over the past few centuries. And one of the most attractive investment opportunity with regard to safety of money invested, adequate liquidity, flexibility in structuring a portfolio. Actually, any portfolio means certain percentage of a debt security is a must actually. So it is providing a flexibility in structuring of a portfolio, easier monitoring, long-term reliability, and certainty of returns from investments made actually. And then important features of fixed income securities. We all know about this face value of a bond or a fixed income security. We know, I will not explain it much. Coupon is nothing but rate of interest paid on a debt security as calculated on the basis of the security's face value. Then coupon frequency is regular intervals throughout the life of a debt security, that is quarterly or semi-annual or annual payments of interest. Maturity date, as we all know, when exactly the security will mature. Discount means when the price of a security is below par value, then it is traded at a discount, and reverse of it is at a premium actually. And price valuation, from the valuation angle, this price of a bond is a key element. The price of any financial instrument is equal to the present value of case inflows. The price one pays for a debt security is based on a number of factors, which includes market interest rates, accrued interest, supply and demand, credit quality, maturity date, state of issuance, market events, and size of the transaction. Yield, the annual percentage rate of return earned on a security. Yield curve, a graphical relationship between yield and maturity among bonds of different maturities and the same quality. Now, weightage average price or yield, it is nothing but a weighted average mean of price and yield, where weight being the amount used at that price or yield. The allotment to the non-competitive segments will be at the weighted average price or yield, as I just explained, and that will emerge in the auction on the basis of competitive bidding. A non-competitive bid means a bidder would be able to participate in auctions of dated government securities without having to quote the yield or price in the bid. So this is an important feature actually as a retail investor, because this pricing of bond or yield of bond is a complex subject. So retail investor is relieved from calculating these two elements, and straight away retail investor will get allotment based on this weightage average price or yield. Now, GSEC as an attractive investment option, these are the points: zero default risk, sovereign guarantee, total safety, lower average volatility in bond prices compared to other markets like mutual fund market or equity market or bullion market or commodity markets. Greater returns as compared to the conventional safe investment avenues like bank deposits, fixed deposits, though they also contain credit risk. Higher leverage, greater borrowing capacity, a wider range of innovation in the nature of securities, that is treasury bills, index linked bonds, partly paid bonds. This we just discussed about stripping process, this separately traded registered interest and principal securities, securities with call and put options. We have better and greater features to suit a large range of investment profiles and investor requirements. This dated GSEC types of instruments, we have fixed rate bonds, floating rate bonds, capital index bonds, inflation index bonds, bonds with call and put options, special securities, sovereign gold bonds, and the saving bonds 2018. Now this separate trading of registered interest and principal securities, it is nothing but stripping is the process of separating a standard coupon bearing bond into its individual coupon and principal components. For example, 4-year coupon bearing bond can be stripped into 8 coupon and 1 principal instruments, all of which thereafter would become 0 coupon bonds. Stripping facilitates right to ownership of individual cash flows. There are various trading strategies which are employed to take advantage of these securities. Now, this is a just sample pricing, which is of 2nd December 2020, and this is published by this Financial Benchmarks India Private Limited or FIBIL, and FIMDA is the calculating agents. Now, why it is old? Because we require credential to access these actually on website of this FIMDA. This is kept as a sample. So I have taken this actually. And as we can see this semi-annual yield on this security is 6.22% for maturity date of 9th March 2029. So around 12% per annum, which is a attractive option. But again, I am telling this is old pricing or old data or old yield statistics. So we have to see the current pricing, and it may not be so attractive now because as we all know, interest rates have decreased over the last few years, particularly after this COVID. And the means nominal rate may look attractive, but real rate of interest is negative also sometimes, looking at current level of inflation. These are the risks associated with investing in fixed income securities: interest rate risk, call and prepayment risk, reinvestment risk, liquidity risk, exchange rate risk, credit risk, inflation or purchasing power risk, volatility risk. These are actually different kinds of risk, and means large institutional investors, they actually make a study of all these risks before investing, because they invest in a major chunk actually. So they take into account all these risks before investing in a fixed income security. Now, these are the contract actually, promisor of the issuer and rights of the bondholders. So they can actually keep a trustee as a representative of the interest of the bondholders. And there are affirmative convents and negative convents. Common affirmative convents are to pay interest and principal on time, to pay all taxes and other claims when due, to submit periodic reports to the trustee of the bondholders, compliance with the loan agreement. And common negative convents includes limitation and restrictions on borrowers' activities, limitations on issuers' ability to incur additional debt unless specific conditions are satisfied. This is basically a contract between issuer and the bondholder. So debtor-creditor relationship is there. Now, money market securities, these also play a very important role within the segment of debt markets. Now, money market is a financial market where short-term financial needs are satisfied, which is of less than 1 year, and they are means traded on stock exchanges. The money market thus can be defined as a market for financial assets that are near substitutes of money actually. The participants in these financial market are usually banks and large institutional investors. There are variety of instruments which are traded in the money market segments of both exchanges, BSE and NSE. The Reserve Bank controls the interest rate of various instruments in the money market. Now, these are the instruments of money market or securities which money market offer actually. We have a Treasury Bills, commercial paper, certificate of deposits, call money, and bankers acceptance. Now, Treasury Bills, one of the most popular money market instrument, and it is issued at a discount and repaid at a par. Means in a way it is a zero coupon bond because it is issued at a discount and paid at a par. So supposing a value of a treasury bill is 100 rupees, then it will be issued for say 99 rupees. So 1 rupee is the discount actually, and on maturity, which can be of 14 days to 364 days, so it will be paid at par, that is full amount of face value, which is normally in India is 100 rupees, and tenure, as we all know, 14 days to 364 days. Now, commercial papers, large corporate issue commercial paper to meet their short-term working capital requirements. Duration of a commercial paper ranges between 15 days and 12 months. Prior approval of RBI is required before issuance of these commercial papers. And again, principle is same. Commercial papers are issued at a discount and repaid at par. Now we have another instrument of a money market, a certificate of deposits, which are negotiable term deposits accepted by commercial banks, and it acts like a promissory notes issued again for all money market instrument. Principle is same, issued at a discount and repaid at par. Duration varies from 3 months to 12 months, and financial institution issue a certificate of deposit for a longer duration up to 10 years. Now, call money, that is scheduled commercial banks lend or borrow on a short notice in order to manage day-to-day cash flows. Interest rates are market driven. Interest rates highly sensitive to demand and supply. Now, bankers acceptance, short-term loan that is guaranteed by a bank, used extensively in foreign trade, and bankers acceptance is like a post-dated check, and banker acceptance saw as a guarantee that an importer can pay for the goods. So in import and export market, this is widely used actually. Now we will move to general principles of valuation of financial securities. We will move to valuation of financial or fixed income securities. So what are the processes? First process is to estimate the expected cash flow. This is based on income approach actually. So estimate the expected cash flow, determine appropriate interest rate that should be used to discount cash flow. Now this is actually most complex area, not easy to determine appropriate interest rate. Then compute present value of the expected cash flow using expected cash flow and the interest rate. So this is the process under income approach, and this is also used in case of valuation of equity, that is FCFE, and valuation of a firm, that is FCFF. Now basic mathematics of calculation of bond prices and yields. Actually, this is a very complex subject, as Sudha madam was also telling. But I made an effort to give just basic mathematical tools. A time value of money in finance, we all are familiar with these concept of time value of money. As we all know, money has a time value, and rupee today is more valuable and useful than rupee a year later. The concept is based on the premise that an investor prefers to receive a payment of a fixed amount of money today rather than an equal amount in the future, all else being equal. Now, PV formula we all know. I will not go into detail of this formula, and this is actually a simple computation of present value. Here we have assumed that rate of interest is 12%, and these cash flows are 10,000 from year 1 through 5. So discount factor we have arrived by taking interest rate of 12%, and this is the present value. So 50,000 received over a period of 5 years will value 36,000, around 36,000 today actually. Now, fixed income security yield. This is very important, either price or bond yield. So these two elements are vital in valuation of fixed income securities. Bonds are generally traded on the basis of their price or yield. However, cash flow patterns, that is outflow or inflow, and other features like coupon, term to maturity, etc., or YTM, etc., vary significantly related to each fixed income security. Therefore, fixed income security are generally compared in terms of yields instead of in terms of their prices. Bond yield measures are current yield, yield to maturity, and realized yield. So what is current yield? Current yield is very simple, interest amount, current price into 100. So if we assume that a bond price is 1,000, par or face value of a bond is 1,000 rupees, and its current market price is 950, and coupon is 12%, and it is paid annually, then current yield will be equal to 12.63%. So this computation is easy actually. Then what is yield to maturity? Now this is actually this term is frequently used in bond market actually. Means secondary market quotes are also based on this yield to maturity. So yield to maturity or YTM reflects the total return anticipated on a bond if a bond is held until it matures. This is actually very important condition. It should be held until it matures. If you sell in between, this YTM, whatever we have computed will be negated actually. So primary condition is it should be held until it matures, and YTM is expressed as an annual rate. YTM is the internal rate of return. Now these terms we are familiar in the capital budgeting proposals, internal rate of return. So YTM is nothing but this internal rate of return. In MS Excel, we can easily compute with these function of internal rate of return of an investment in the fixed income security, assuming that the investor holds the bond until maturity with all payments made as scheduled and can be reinvested at the same rate. This is also an important condition, can be reinvested at the same rate. If the market price is equal to par value of the bond, then YTM will be equal to coupon rate. YTM will be different only when a bond will be sold either at a discount or at premium. So if the market price is greater than a par value of the bond, then YTM will be less than coupon rate and vice versa. So this is actually a simple calculation. Here we have taken par value of the bond as 1,000 rupees. Coupon 12% annual, redemption at par, and current market price of the bond is 900 rupees, and term to maturity is 5 years. So this is actually 14.98% is YTM, and we can actually easily calculate this with the help of IRR function in MS Excel. Now, realized yield or holding period return, it is comprising of two elements. Number one is interest received, and number two is capital gain. which is then divided by purchase price of the bond, and annualized holding period return. This is the formula actually, 1 plus holding period return raised to power 1 divided by n minus 1. So assuming that par value of a bond is 1000, coupon is 12% annual, bond is sold at rupees 910 after 3 years, and the purchase price of the bond is 900. Term to maturity is 5 years, and capital gain tax we have assumed as nil. So holding period return in this case will be equal to 41.11%, which is for a period of 3 years, because it is sold after 3 years. So annualized holding period return is equal to 12.16%. So this is actually a formula. What I will do at the end of all this calculation, I will take you to Excel also, Excel worksheet, and there we can easily make a computation. Now we have this treasury bills. Treasury bills are nothing but money market instruments issued by the government of India, as we have just seen. Treasury bills are short-term debt instruments. Presently, treasury bills are issued for 91 days, 182 days, and 364 days. Treasury bills are zero coupon securities and pay no interest. So what I have done, I have made an effort to take current rates of interest which are paid by banks on fixed deposits. So as we can see, the maximum rate of interest for 1 and 2 year is 5.1% by SBI and around 5.2% by ICICI Bank, again 5% by HDFC Bank, and in case of Bajaj Finance, it is slightly higher. So compared to this, actually return from this treasury bills is also almost equal, and it comes with sovereign guarantee. So what else we can require for making a security as risk free? So this is actually a major means in case we want to invest for a short duration of less than 1 year, then according to me, this treasury bill or investment in treasury bill is attractive, most attractive, and because it comes with a sovereign guarantee, so virtually it is risk free actually. And banks actually invest means, as we all are aware, the banks, commercial banks, they maintain SLR. So for that 25% SLR, statutory liquidity ratio. So for that, actually they invest in a large scale in government securities, including this treasury bills. And though the statutory limit is 25%, but bank actually invest to the tune of 35%, 40% in excess of statutory limits, because it is a risk-free investment. So as a retail investors also, this is a means attractive investment option for a short duration. Because if you have spare money for just say 91 days, you can very well purchase this treasury bills. Now, how to compute YTM on treasury bills? So that is this is the formula: 100 minus principal divided by principal into 365 days for a year into days of that commercial, or sorry, treasury bill into 100. Where P is the purchase price, day is days to maturity. Now, assuming that weightage average price of a treasury bill is say 99.0651, 97.8977 and 95.6051 for treasury bill having a tenure of 91 days, 182 days and 364 days respectively, yield will be computed as follows. So this is the formula, and for 91 days it is around 3.79%. For a period of 364 days, it is around 4.6%, and for 182 days, it is 4.31%. So this is actually real. Means a few slides back, I had shown you real auction data of Reserve Bank of India on 23rd March of means current month, actually 23rd of current month. So this I have calculated from that actual data only. So here actually, as we can see, the annual rate is 4.60%. And in previous slide, as we can see, SBI offers a 1 year interest of 4.4%. So compared to these banks, actually, we get a slightly higher rate in case of treasury bills. So this opening of account with RBI, we can take this advantage, because on a regular basis we can make investment. RBI, what it does from time to time, it publishes auction notices. Means mostly in a month. In the beginning, actually, auctions are scheduled. So if we participate through this retail gilt account, then we can very well take advantage of this risk-free rate, which is slightly higher than bank deposits. And again, tenure is comfortable of 91 days, 182 days, and 364 days. Now, how to compute the price of a bond? So here, just give me a minute. So price of a bond, if we assume the face value of a bond is 100 rupees, maturity period is of 5 years, and coupon is 10%, which is paid annually. Expected rate of return, that is our discounting rate, is 12%. So based on this, actually, we can compute price of this bond, which is having a par value of 100 as 92.79 paise. So this is actually very easy calculation, this annual cash flow. And as we can see, last year, that is at the time of maturity, this principal amount of 100 is the inflow. So that is also taken into consideration. Interest of each year, or coupon payment of each year, and in the last year, coupon payment plus principal amount. And these are discounting factors, which are computed by taking discounting rate of interest as 12%. So present value we have to compute by multiplying this cash flow with the discounting factor. Now, how to compute price of a bond? Again, this is another example. And in these, actually, coupon payments are semi-annual. So maturity is same 5 year, face value of bond is same 100 rupees, expected rate of return, again I have assumed same 12%. So this cash flows means 5 rupees every half year. So total there are 10 periods for 5 years actually, and cash flow will be half, that is 5 rupees, and at the end of last period, that is maturity, 105 is the cash inflow, and discounting factors, and again we have calculated a PV 92.64%. So in previous example, it was 92.79 when it was annual, and in this case price is slightly less because inflows are semi-annual instead of annual. Now, how to compute duration of a bond? This is again an important element of bond valuation. Duration of a bond is number of years taken to get back the initial investment of a bond. It is calculated as the weightage average number of years to receive the cash flow. Now, assuming that a bond is having a face value of 100, maturity period of 5 years, coupon 10%, expected rate of return 12%, the duration of the bond will be calculated as per these details actually. Year 1 to 5, we have case inflows of 10, 10, 10, and last year again 110. Now, present value, as we have computed in this previous example, it is 92.79. Now, this present value is multiplied by the year actually. So, this 8.93 into 1, that is 8.93, then 7.97 into 2. So, we will get 15.94. So, like that, total we get 383.73%, and duration of the bond is 4.14 years, which we get by dividing this PV into time by this present value, that is PV. So 4.14 years. So we can say a bond having maturity of 5 years, we will get our initial investment back in 4.14 years. So this is actually vital element of bond valuation or bond pricing. Then how to compute modified duration of a bond? So modified duration is a modified version of Merkle duration, which is showing the change in value of security to 1% change in interest rates, that is yield. Now again we will have same assumptions, that is face value 100, 5 years maturity, coupon 10%, expected rate of return as 12%, and duration of the bond which we computed as 4.14 year in a previous example. The modified duration will be 4.14, 1 plus 0.12, that is 12%. So we will get modified duration as 3.69%. So what this reflects actually, this reflects that every increase of 1% in the rate of interest will actually decrease the price of the bond by this 3.69%. So that is the significance of duration. Means it has an inverse relationship with price. If interest rate goes up, then price will be decreased, and if interest rate is decreased, then price will be increased. And to which extent? It will be to the extent of this 3.69%. Now, how to compute value of a zero coupon bond? A zero coupon bond, as we all aware, we do not get coupon payments at a regular interval. Instead, the bond is actually issued at a discount, and on a maturity, we get the face value or par value of the bond. So in this case, we have assumed that this zero coupon bond is having a face value of 100 rupees, maturity of 5 years. Expected return is 10%, issue price is 80, redemption price is 105. So value of ZCB is 65.20%. So only we have taken cash flow in the last year, that is fifth year, which is 105. And duration of zero coupon bond is always equal to its tenure or maturity period. Means as in previous example, we have seen the duration of a 5-year bond was 4.14 years, but for ZCP, it is always equal to its tenure. That is, in this case, it will be 5 years. Now, credit rating agency are important gatekeepers of the debt market. The demand of rating has increased gradually and manifold in the recent past. Credit rating agency, as we all are aware, assign ratings to securities. It also assign sovereign ratings, that is to countries, state governments, local government bodies, companies, non-profit organizations, special purpose vehicles or special purpose entities. Credit rating agency take into consideration several factors like financial statements, level and type of debt, lending and borrowing history, ability to repay the debt, and past debt of the entity before rating their credits. Credit rating agency also provide ancillary services like market forecast, estimate of economic trends, pricing analysis, and other general data analysis. Now, actually, we have 3 major credit rating agency globally, that is Standard & Poor's or S&P, Moody's and Fitch. These are the 3 major global players, and their combined market share is around 90%. And in India, we have CRISIL, which is the oldest credit rating agency, and there are around 5 to 6 other CRAs. Now, CRAs assigned different credit rating scales for long-term and short-term, which are classified as prime grade or high grade or upper medium grade, lower medium grade, non-investment grade. So these are actually classification. And for example, this credit ratings scales assigned by Moody's are highlighted here. AAA means AAA, then AA1, AA2, like that they assign the credit rating scales. And short-term, these are actually long-term credit rating scales, and short-term rating scales are also assigned apart from this long-term rating scales. Now we will move to this International Valuation Standard 500. As a valuer, we keep track of valuation standards. So valuation standard for financial instrument is IVS 500. And in this, actually, definition of a financial instrument is given. Financial instrument, as we all know, is a contract that creates rights and obligation between two parties to receive or pay cash and other financial consideration. And such instrument include but are not limited to derivatives, other contingent instruments, hybrid instrument, and fixed income securities or fixed income instruments, structured products, and equity instruments. So financial instrument can also be created through the combination of other financial instrument in a portfolio. to achieve a specific net financial outcome. Now, valuation of financial instrument can be performed for different purposes, including but not limited to, these are the transactions actually, acquisition, mergers and sale of business or parts of businesses, purchase and sale, financial reporting, litigation, internal risk and compliance procedures, etc. And these financial instruments, credit risk adjustment, own credit, counterparty risk, subordination, leverages, netting agreements, default protection. So these are the elements we have to take into consideration as a valuer, which are specified in international valuation standards. Now this is actually, there is a typographical error. This is Institute of Chartered Accountant of India, Valuation Standard 303, Financial Instruments. For the purposes of this standard, financial instrument gives rise to financial asset of one entity and financial liability or equity instrument of another entity. Equity instrument, derivatives, debt instrument, fixed income and structured products, compound instrument, etc. are certain example of financial instrument. So these are the guidelines given under this ICAI valuation standard 303. Now these are guidelines for valuation of investment, which is issued by Financial Instrument Association, means Fixed Income Money Market and Derivatives Association of India, or we call it as FIMDA, Fixed Income Money Market and Derivatives Association of India. It is association of commercial banks, financial institutions and primary dealers. It's a voluntary market body for the bond, money and derivatives market. Its function is principal interface with the regulators on various issues that impact the functioning of these markets. It also undertakes developmental activities such as introduction of benchmark rates, new derivatives instruments. Market participants are required to ensure valuation of their investment portfolio in accordance with the direction guidelines circular issued by the RBI, both for banks and primary dealers. And in these connection, actually, these are important circulars. RBI Master Circular, Prudential Norms for Classification, Valuation and Operation of Investment Portfolio by Banks, which is issued on July 1st, 2015 and amended from time to time. And this is another RBI circular which is issued in the year 2018. Now, these are the guidelines for valuation of investment. Valuation of central government securities. All central government securities, whether SLR as well as non-SLR, that is statutory liquid ratio, to be valued as per prices published, prices or yield published by Financial Benchmarks India or FIBIL. FIMDA is the calculating agents. Similarly, for state governments securities, it is calculated as per methodology approved by RBI and implemented from 15th of April 2019. Now, these are actually available on the website of FIMDA, actually, these prices and yields on a daily basis they put up. But for accessing these details, we require credentials, actually. Treasury bills will be valued at the carrying amount. Floating rate bonds issued by central government, these rates are published by FIBIL and FIMDA as the calculating agent. When traded price is to be used for valuation of floating rate bonds. And when not traded, then market observable and tradable price, if available, will be taken. And if these two prices are not there, that is traded and this MOT price, then model prices are generated as per procedure appearing on FIMDA's website. There are other special securities issued by Government of India like oil bonds, fertilizer bonds, etc., which are valued by adding 25 bips or basis point to the base yield curve, which is as per para 37.1 of RBI circular. Now, inflation index bond. Now, these are the actually summary of guideline issued by FIMDA. Now, we will move to accounting standards actually. So, for financial instrument, these are the Indian accounting standards. Indian accounting standard 32 is for presentation. Indian accounting standard 107 is for disclosures, and 109, Indian accounting standard 109 is for guidance on the recognition, derecognition, classification and measurement of financial instrument, including impairment and hedge accounting. And again, fair value of financial instrument is determined as per Indian accounting standard 113. So in all, there are 4 accounting standards which are relevant for valuation of financial instruments, apart from valuation standards issued by international valuation standards and ICAI valuation standards. Now, financial instruments, as we know, it is a financial asset of one entity and financial liability or equity instrument of another entity. And definition of financial asset. So examples are investment in equity instrument, investment in debt instrument, trade receivable, cash and cash equivalent, derivative financial assets. So these are actually definitions which is given in this accounting standard. And financial instrument, financial liability, examples are trade payables, loans, bank overdraft, bills payables, redeemable instrument, preferences, debenture, financial guarantee given for repayment of debt upon borrower's default, etc. And these are the definitions again given for financial liability under Indian accounting standard. Now, classification, this is important under this accounting standard. We have financial assets and financial liabilities. So, financial assets are classified at amortized cost or fair value to other comprehensive income and fair value to profit and loss account. And financial liability are either classified under amortized cost or fair value to profit and loss account. So based on classification, actually these methods will be applied. So what is the classification? So for financial assets, for amortized cost, actually business model is important. So business model, there are 2 models, hold to collect plus SPPI, contractual cash flow test. So what is this SPPI test? It means that contractual cash flows comprise of nothing but principal and interest payments. That is solely payments for principal and interest. And business model test is determined by the entity's key management personnel or KMP in the way that assets are managed and their performance is reported. So same test is to be carried out for these three concepts, that is amortized cost, fair value to other comprehensive income, and fair value to profit and loss account. Now, these are the key concepts. An entity should recognize a financial asset or financial liability when and only when the entity becomes a party to the contractual provision of the instruments, plan future transactions and other expected transactions, no matter how likely, are not recognized as financial assets. So, merely based on planning, these transactions are not recognized as financial assets or financial liability because the entity has not yet become a party to the contract. Forecast transaction is not recognized in the financial statement, even though it may be highly probable. So this is very important. When entity becomes party to the contractual provision of the instrument, then only it should be recognized. And these are actually event. So for initial measurement, fair value plus transaction cost under this amortized cost classification. So this will be the value, fair value plus transaction cost. For a subsequent date, that is balance sheet date, amortized cost by effective interest rate. Now, what is this effective interest rate? That we will see in next slide. Loss or gain on subsequent dates, it will be accounted in a profit and loss, and a periodic return will also be accounted in profit and loss. When it will be done? When it is based on amortized cost. Now, for a fair value to other comprehensive income, it will initial measurement again will be fair value plus transaction cost, and for subsequent date it will be fair value, and loss and gain will be accounted in other comprehensive income, and periodic returns will be accounted in profit and loss account. And fair value to profit and loss concept, initial measurement and subsequent date will be accounted at fair value, and loss gain and periodic returns will be accounted to profit and loss account. Now, liability held for trading designated through fair value through profit and loss and other situation. So fair value through profit and loss, we have examples, derivatives, financial derivatives, held for trading, financial guarantees and contingent consideration. And this fair value through designated through fair value through profit and loss, it will be accounted in fair value through profit and loss. And other situation, amortized cost, and examples are loans, debentures and creditors. Now, compound financial instrument means in legal form it is a single instrument, but it is comprising of both liability and equity instrument. Such instruments are classified separately as financial liability, financial assets, or equity instruments. So mainly it is this convertible preference share with dividend or convertible bonds. These are the instrument. So what is liability component? Liability component is a principal redemption liability, and in case of convertible bonds, it is a principal redemption and interest payment liability. And what is equity components? So equity components in case of preference shares, it is dividend, and for convertible bonds, it is convertible option to the holder. Now, what is the procedure? First, we have to determine fair value of liability component, including any embedded derivatives, that is financial liability. Then whatever is left or whatever is a residual instrument, it is equity. In split accounting, the issuer of compound instruments classify the liability and equity components of the compound instruments separately as financial instrument and equity. Now, this is actually, when we understand, it is easy. On face of it, it may look difficult. I have actually calculated one such example in next slides actually. So transaction cost are incremental costs that are directly attributable to acquisition, issue, or disposal of a financial instrument. And examples are debt premiums and discounts, financing cost, internal administration cost, holding cost of financial instruments. Now, measurement of transaction costs: asset classified at amortized cost or fair value to other comprehensive income. Initial measurement of the asset is at inclusive of transaction cost, as we have seen in the previous slide also. It includes inclusive of transaction cost. And assets classified at fair value through P&L, then initial measurement of a transaction cost is a profit and loss account. So first two categories, transaction cost will be included in the asset value, and this fair value through profit and loss, transaction cost will directly be debited to profit and loss account. Now, this is actually practical example of split accounting. In this, we have assumed that XYZ issued 1,000 convertible bond with the following characteristics: face value 100, term 4 years, issue at par, coupon 8%, payable annually, frequency is annual. Each bond is convertible at any time up to maturity into 25 equity shares, and prevailing market rate of interest for similar debt without conversion option is 10%, and XYZ incurred cost for issuance of bond amounting to 5,000 rupees. So total proceeds of bond will be 100 into 1,000, that is 1 lakh rupees. And annual interest liability at the rate of 8% will be 8,000 rupees. So this is actually a calculation which I have done in Excel actually. So cash flow from year 1 to 4 actually, 8,000, 8,000, 8,000, and in last year it will include principal amount also. As we have seen here, term is of 4 years and coupon is 8%, and face value of 100, and total 1,000 convertible bonds are issued. So this the outflow per year or per annum will be 8,000 for year 1 to 3, and in 4th year it will be inclusive of principal, that is 1 lakh plus 8,000, 1 lakh 8,000, and this is a discount factor at 10%. So present value we have arrived total of 93,660. So total proceed is of 1 lakh, and liability components as per this calculation is 93,660. So equity component will be 6,340, which is nothing but a balancing figure. And allocation of transaction cost between equity and liability. So gross proceed of liability component is 93,660 as we have seen, and equity component is 6,340. So total is 1 lakh. Issue cost of 5,000 rupees is distributed on pro rata basis, which will be 4683 for liability and 317 for equity. So we have net proceeds of 88,977 and 6023 respectively, total 95,000. Means 1 lakh is the gross proceeds and issue cost is 5,000. So total receipt or net proceed is 95,000, which is divided between liability 88,977 and equity 6023. Now allocation of debt, this is actually year-wise allocation of debt. So opening liability, then effective rate of interest. Now this is actually key point, how we will get this effective rate of interest. So in Excel, actually, we can easily find out through goal seek function. There is a goal seek function under data tab. So we can easily find out this effective rate of interest. How we can find out effective rate of interest is the discount rate at which present value of interest and principal payments over 4 years is equivalent to 88,977. The rate is ascertained through goal seek function in MS Excel. And if we don't want to use this function, then we can also use this trial and error method. Means we can apply different discount rates and arrive at this effective rate of interest. Now opening liability we have taken from this previous slide, that is liability component net proceed. So this 88,977 effective interest at 11.6% is 10321 and case paid is 8,000. So closing liability will be 88 plus this minus this, so total 91. Like that, this allocation of debt to each year will be made. So with this, actually, I will conclude my session. Actually, now it will be open forum. If you have any questions, you may ask. Actually. Any question from participants? Or we may conclude otherwise.
Good evening, sir.
Good evening, madam. How are you?
I'm fine, sir. It was a really great deliberation. In fact, you made things so pretty clear that we don't have question, actually. We have no queries left.
So kind of you.
Okay. So I consider it a great privilege, sir, on behalf of AVP to propose a vote of thanks to all the dignitaries who are present here, particularly to our speaker, sir, who have enlightened us on this elaborately on this topic of fixed income securities. And apart from that, I'd also like to extend my heartiest a big thank you to Veronica ma'am, Amit sir, and Ashmita ma'am, and obviously Sandeep sir for always guiding us throughout, and also to Sudha ma'am, who is always a savior. It was a great session, sir. Thank you so much once again.
Thank you. So we will conclude now.
Yes, sir, we got conclude. Yeah.
Thank you.
Thank you so much.
Thank you.